Joint ventures are important in real estate because they complement the capital of the investor and the know-how and technical expertise of the manager and bring them together in a sophisticated vehicle to deploy an investment. Joint ventures allow investors to invest in markets they wouldn't otherwise be able to do through a partnership with a manager. Joint ventures in real estate are different from other joint ventures largely due to the passive nature of a real estate joint venture versus another joint venture, and more importantly, the role of the manager. The manager delivers performance or is hired to deliver performance, and that is not a feature that is common on other joint ventures.
There really is no one typical structure for a real estate investment. It really depends on who the investors are, what type of investment we're making, what sort of asset class it is, whether it's commercial estate, residential real estate, development real estate, and also in part depends on where the real estate is located. But if you ask me, broadly speaking, what type of investment structures exist, I think they fall into one of three distinct categories. On the one hand, you could have a contractual joint venture. This is where disparate investors club together and, under the terms of a joint venture agreement, separately decide to invest in real estate or in a real estate structure. The returns are governed by the terms of the joint venture agreement. At the other end of the spectrum, I think it's a corporate joint venture. This is where the investors establish a corporate vehicle to make the investment in the underlying asset or structure, and they invest into the corporate by means of equity or debt. And in the middle of that would be a partnership joint venture. Now, this could be either in the form of a limited partnership, where you have a general partner who runs the show and basically makes all the decisions for the investors, and the investors are merely passive investors looking for a passive return. Or on the other hand, if they wish to be more active, they could form a limited liability partnership, in which they would have an active say in the running of the partnership, but it would preserve the limited liability feature that was present in a corporate JV, whilst preserving the flexibility of a partnership in which income would arise directly into their hands rather than into the hands of an opaque vehicle.
Real estate has always been an attractive option for investors. If we look at these two graphs, they show the Eurozone property yields and the UK property yields over the last 9 years. The grey line in each case represents property yields, whereas the blue line represents Eurozone and UK government bond yields, respectively. The purple line, the 5-year swap rate, and the yellow line, Euribor and LIBOR rates, respectively. What we can see from this is that property yields have fared extremely well compared to their bond equivalents, and this is why investors are keen to explore real estate as an investment opportunity. English law is very attractive, not only for UK joint ventures, but also on cross-border European joint ventures. This is because English law is stable, we have a precedent-based system, and we have a very developed court structure. None of these things are expected to be affected by Brexit.